Good afternoon and welcome to this Asialink Business seminar. Today we're here to talk about the federal budget update and what it means for our economy, trade and investment with Asia. My name's Corrina Bertram and I'm a partner at KPMG and a member of our board. And I'm also very proud to be a member of the Asialink Business Advisory Council. I'd like to begin today by acknowledging the traditional owners of the lands on which we meet. For me, that's the Wurundjeri people of the Kulin Nation. And I pay my respects to elders past, present and emerging, and to all First Nations people on their lands across the country in which we're fortunate to be gathered on today. To start off, I'll just note some housekeeping points. We are recording this webinar so it can be shared after the session. If you have any questions for our panellists, please use the Q&A function and we'll endeavour to answer those at the end of our session when we have an open Q&A forum. So as we all know, the federal budget was handed down on the 9th of May. And today we're joined by speakers who can help us to dissect it and to understand a bit more of the detail. We'll be looking in particular at aspects that affect Australian businesses and what we can learn in terms of the funding that's available to enhance Australia's economic and strategic engagement with Asia. So I'm very pleased to introduce our speakers to you today. We have both Jarrod Ball and Robert Law. Jarrod Ball joined CEDA as the Chief Economist in 2017. And he has over 15 years' experience as economist across both the public and private sectors. He's held senior positions at the Business Council of Australia, with EY in their advisory services practice, and more recently, he was at BHP. Jarrod's also worked in the federal government across a number of microeconomic policy reforms and the Victorian departments of Premier and Cabinet and Treasury and Finance. Jarrod is a member of CEDA's Council on Economic Policy, and he's also at the Melbourne Economic Forum. Jarrod holds a master's degree in economics, as you would expect, from Monash University, and he has an undergrad of business of economics and arts majors at the University of South Queensland. So thank you for joining us, Jarrod. We're also pleased today to welcome Robert Law, who is the Director of Advisory and Insights at Asialink Business. Rob is very passionate about helping businesses to unlock their potential and to grow in Asia. He has extensive experience developing market entry strategies for markets such as India, Japan and Indonesia, and across a range of sectors such as consumer products, food, beverage, ag, technology and education. So without further ado, I'll open the floor to Jarrod, who's going to share some of his insights from the federal budget. Thank you so much, Jarrod.
Thanks for the intro, Corrina. And look, I want to set the context around the budget today by talking about four things. One about the economy, second about what the government's done in this budget, thirdly, what's missing from this budget, and finally, the long-term challenges that remain after this budget. Budgets don't occur in isolation or in a vacuum. They are very much shaped by the economy, and this one certainly fits into that category, absolutely. The economy did, I think, most of the heavy lifting in this budget. It was those upgrades in economic forecasts that have really seen us in a much better fiscal position than we otherwise would have been and were in October last year. Commodity prices, a really strong labour market, and also company profits saw $130 billion of extra revenue come into federal coffers to make that job so much easier in this budget. Unfortunately, there are tougher times ahead. So while we do have that short-term temporary boom, there's some tougher times ahead for the economy. We are seeing global growth at the lowest level that we've seen in 20 years, and we're going to see 1.5% economic growth next year here in Australia. And I guess the silver lining to that next year is that we are going to see inflation finally come down. And we've seen a little bit of a hint today in terms of the employment numbers that maybe the RBA's medicine is finally starting to get through the system, and we will see inflation lower. And we also should see real wages start to rise again next fiscal year, which is a good thing. One of the other things that we saw, which has really helped Australia to outperform a lot of other advanced economies, is strong migration. And we see that coming right through the budget numbers and contributing to the fiscal outcomes that we've seen. And we are looking at net overseas migration of 400,000 in this fiscal year, and then about 315,000 next fiscal year. And that's above what we would usually expect, around the 260,000 mark pre-COVID. So this is really helping. It's really helping in terms of services exports. And you can see that in the budget, there's a particular section that looks at the issue of services exports and the increased contribution that we'll see from services exports to our exports coming up over time. So given all of that, what has the government done in this budget? Well, it was very much framed around the issues of relief, repair, and restraint, and that they were kind of the KPIs that the government set itself and how it's marketed this budget. If we look at the relief kind of bucket for cost of living relief, there was over $16 billion of cost of living relief. It was relatively well targeted. I think it came in above what people probably expected coming into the budget, but it was quite well targeted to things like Commonwealth rental assistance that have been lagging what's been happening in the rental market for quite a long time, and looking at particular income support measures and for particularly vulnerable groups. Now, economists have sort of argued the toss around the inflationary impact of all of this, some saying it's highly inflationary and others saying it's disinflationary. I think the truth lies somewhere in the middle. I think there is a small inflationary impact of what we've seen in the budget, but I think we also need to remember that a lot of that relief is in the out years. Now is when we're feeling inflation really bite, but hopefully we get inflation under control. And so a lot of that relief is actually happening in the out years of the budget. And so I think we need to keep that in mind. On the repair side, not a lot of policy-induced repair in this budget. It's really come from the economy, and those upgraded economic forecasts that we've seen have been the thing that's really driven the recovery. We really saw a fairly minor set of technical tax measures to raise an additional $22 billion in this budget. Things like increasing GST compliance. We obviously saw some changes to the petroleum resource rent tax, which were actually relatively well accepted by the sector relative, I think, to some of the things that may have been canvassed around those sorts of measures. So not a lot of structural repair in this budget, more making sure that we take advantage of the economic circumstances that we've had. And finally, the issue of restraint. And again, unsurprisingly, an area where economists are arguing how restrained the government has been in this budget. They did run a surplus in this current financial year. That's probably a strong signal in terms of restraint. Doesn't necessarily change a lot between a slim deficit or a slim surplus economically, but it is a sign of that level of restraint. They did bank the majority of those temporary tax windfalls, which was good to see as well. And we have seen a lot of trumpeting about the really low real spending growth that we see in this budget, 0.6% a year over 5 years. Again, a lot of people have contested that. They've said, well, actually, if you look at the 4 years and don't take the current year into account, the spending is actually growing at 1.8% a year. But again, that's still below some of the kind of benchmarks that we've seen historically, like the 2% real spending cap. So it's still a relatively restrained budget. Having said that, they did manage to spend $43 billion, which was obviously funded in part by those tax windfalls, but also those tax changes that I spoke about as well. So what's sort of missing in this budget? Well, we did see a good job on relief, and certainly a lot of the community reacted well to some fairly modest cost of living measures. But there's very little in this budget to build productive capacity in the economy, and very little new investment to build productive capacity. It's understandable that infrastructure spending has had to be, reprioritized given where the market is at currently, and it's saturated, and you're going to see cost pressures. So there's no point in continuing to kind of stoke inflation in that area. But we haven't seen too much in other areas. We've got the National Skills Agreement. That's been in the budget for a number of years now. So that's not new funding, although it is absolutely critical and welcome, the $3.2 billion there. We saw $392 million for the new industry growth programs, which is really about grants for smaller businesses to gear up for the National Reconstruction Fund. So I think it will be interesting to see the extent to which that is utilised. I'm sure Rob will talk a little bit about that as well. What we would have liked to have seen in the budget was something a little bit more novel to kind of try and encourage productivity. And one of the things that we've talked about is having a pool of funding in which the states and territories could bid into around productivity reforms that they could pursue, because we certainly see that a lot of the potential to increase productivity actually sits with the states and territories, whether this is things like stamp duty, insurance taxes, planning and zoning. These are the sorts of things I think that we can use to get more investment and activity in the economy and boost productivity. There are remaining a lot of long-term challenges after this budget. The budget itself faces considerable long-term challenges. Really, something that's not being talked about all that much is the fact that we've actually lifted to a new level of spending in the budget as a result of NDIS and new kind of services that obviously the community is demanding. We're now looking at a 26% of GDP spending in the budget, and that's going to stay there over the next decade. We need to pay for that, but at the same time close the medium-term fiscal gap, which really presents a challenge. The budget assumes that that gap is going to be progressively closed over the next decade, essentially through good fortune of the economy and a little bit of restraint and repair around things like the NDIS. I think that's overly optimistic. I think we can only face the unavoidable conclusion that we are going to need tax reform, whether that is to lift the level of tax that we have in Australia to fund these services that we have, or if it's to collect tax more efficiently so that we're not stinging growth quite as much, so less of that reliance on income taxes and more reliance on more efficient taxes on consumption and wealth. There is also a large opportunity cost of debt. Those interest payments are significant as much as debt has stabilised. We're still looking at interest payments being one of our largest spending programs going forward. And so that does present an opportunity cost of areas where we could be spending money in other areas. And finally, I think a big challenge over that medium term is to really be ambitious about growth. Strategically, where we want to play in terms of some of the key sectors, the opportunities that are out there in terms of being an green energy superpower, looking at where we might have more advantages to play in global value chains going forward, I think is really important. We have an excellent migration review that has been done that has set some really important directions in terms of the migration system and how we can get that right. That is critical because all advanced economies are aging at the very same time and at quite a rapid pace. And so we're going to have a lot of countries competing for the same global talent. So we absolutely need to get that right. And finally, we need to be hungry for investment. Investment as a level of the economy is back at 1990s recession levels and has been for a while. We haven't managed to really get the green shoots turning over and get investment back, which is going to be critical to productivity. And I think we do need to be a little less complacent, a little more hungry for global investment in future. So with that, I'll leave it at that and might hand over to Robert for the next section.
Thanks, Jarrod. And that was an excellent scene setting in terms of where the budget's at. Jarrod really touched on the theme of restraint. And we certainly saw that restraint flow through in terms of budget measures related to businesses, higher education providers, and other organisations in the broader Asia engagement space. So what we've done is we've gone through the budget papers and taken a look at them. And we've attempted really to draw out measures that might be relevant to your business, whether you're exporting goods or products, or you're in the investment space, maybe you're in the agricultural field, whatever it might be. There are a few interesting policies and programs that are worth a mention. So we'll just step through those now for you. So I've got some slides to share, which should be coming up any minute now. we'll just start off broadly with the foreign affairs, trade and investment space. And really, as you look at these slides, we haven't focused on measures of investment into the public service. But what you can see there is the government's put a real strong focus on Southeast Asia. They're in the process of developing a Southeast Asia economic strategy, and Nicholas Moore is leading that process and has been appointed as the special envoy for Southeast Asia. That process is still ongoing. So the strategy is going to be released in the second half of the year. But we have seen in the budget that there's been some front loading of spending connected to that strategy to really boost Australia's diplomatic and economic engagement when it comes to Southeast Asia. An interesting measure that we saw in the budget papers, and many organisations might look at this and think it's a bit more in the development space, is the Emerging Markets Impact Investment Fund. So this does come from ODA, so development money. But this was a fund that has been established for a little while now with a small amount of capital, about $40 million. But what the government is doing is they're really increasing the capital that fund has to play with. Now, the expectation here is that this measure is neutral in terms of the budget. So this investment should return money to the government coffers over time. And the focus of this fund is really investing in small and medium businesses in the Asia-Pacific region, but really bringing that gender equality and sustainable development lens. So there have been a number of investments so far in Vietnam, Indonesia, Bangladesh, and the Philippines. So if you're thinking, oh, this sounds really interesting for my Australian business, what you need to know is that this isn't really targeted at Australian businesses. It's targeted at, small and medium businesses in the region. But I think it's worth mentioning this fund because we do know that a lot of Australian businesses work in partnership with regional businesses and regional partners. So as you're engaging, and we've worked with businesses in the agri-tech space, the fintech space, as you're thinking about your engagement with your regional partner, and if there's a strong sort of gender equality and sustainable development lens to what they do, this fund may be of interest going forward. The simplified trade system, that's a measure that the government's taking to really streamline exporting and importing. So really removing a lot of that red tape. That's been established for a little while, that initiative, and that's ongoing. One of the really interesting measures in the budget was the export market development grants. And we know so many businesses that have been able to take advantage of these grants, and they've really been quite useful. However, there's also been a number of challenges associated with these. So these grants are really in the go-to-market space for businesses. They're about, developing your strategy, your marketing in target markets. There's been an operational review recently of EMDG, and there's been some changes to fine-tune the process, the program. But you can see going forward, it's only funded for the next 2 years. So what that seems to indicate is that the government is going to think again how it supports businesses when it comes to exporting. And I think there is a pretty big opportunity here, which I'll touch on in a minute. The last two there, just worth noting in terms of continued funding, just to take the bottom one first, it's great to see funding continue for the new Colombo plan. That's a really important measure to help young people, build their understanding and their Asia capability. So really glad to see that continued funding. And then the Centre for Australia-India Relations, previously announced, it's all been announced previously, so this is not new money. But it's worth noting because this is, again, sort of coming online in the middle of this year, the second half of this year. So there's a range of sort of programs and scholarships and fellowships available through that centre that might present opportunities for businesses engaging with India. So if we move on to the next area, which is the industry science and resources portfolio, Jarrod touched on this one, the industry growth program. So this is very new. We don't know a lot about it. It's got to go into the design process now. But this program essentially replaces the Entrepreneurs Program, which was an initiative of the previous government. And the idea is this is targeted more at SMEs, and it's with the aim of sort of preparing them to grow their business and in future, access the National Reconstruction Fund. So I do think that this industry growth program is a great opportunity for the government to think again about how it supports and incentivises businesses to export. When you have something like the EMDG program, which is really focused on the go-to-market side of business, but it didn't really deal with the sort of core capabilities that a business needs to engage in the international space. We know that if you start exporting to another country, there's all sorts of challenges for your finance team in terms of, how they receive and quit funds and currency exchange and all those sorts of things. There's challenges for your HR area in terms of managing a team cross-border potentially. And then there's all these sort of operational challenges that a business needs to deal with. And what we see is a lot of other countries, Singapore and Germany, most notably, in terms of their export support programs, they really bring a holistic view to supporting businesses and equipping them with everything they need to engage internationally. So I think there's an opportunity there to really design and shape the industry growth program in a way that does that and perhaps bring some complementarity to whatever comes after the Export Market Development Program. Of course, you see there the National Reconstruction Fund previously announced, but there was some money in the budget to operationalise that and to stand up the corporation. So that will be quite important for investing in future capabilities around advanced manufacturing, space and other things that the government really wants to build. Interestingly there as well, we saw a little bit of money as well for the critical mineral space, obviously with all the focus on, batteries and EVs and the critical mineral supply chain. The government's putting more of a focus on that. That does look like it has come at the expense of the Resources and Metals Market Access and Preparedness Program. That program was really about helping businesses in the mining, equipment, technology and services sector access new global markets. And so that funding's being discontinued. Go on to just one more slide. Couple of measures worth noting. Look, there's been plenty made of the hydrogen funding in the budget. So $2 billion to accelerate the hydrogen industry. This is really important because the sector's really at an embryonic stage. But what we're going to see over the next 2 to 3 decades is the gradual decline of fossil fuel exports, and ideally Australia positioning itself to export green hydrogen to the world. Now, that's going to take a lot of investment to get that industry off the ground. Another measure there in that climate and energy space is also the National Net Zero Authority, which is going to live under the Prime Minister's department. And that will really be about sort of looking to drive net zero investment, particularly in regional areas. And there'll be a sort of investment facilitation role that will play. And lastly, just to touch on the agriculture, fisheries and forestry space, a lot of people would be familiar with the APMAC program. So a lot of peak bodies availed themselves of this program for diversification over the last few years. So looking to find new markets, developing their market entry strategies and marketing and so on. So that funding has been discontinued. So look, I'll pause there in terms of going through the various lists of policy measures. A little bit in there for business, probably not as much as we would have liked to have seen in terms of supporting and incentivising trade and investment, and also outbound investment. Jarrod touched on the importance of inbound investment, but we believe they're quite linked. And you can build relationships with inbound investors by engaging in outbound investment. So look, some opportunities there to build in those areas in the future. I'll finish there and I'll pass back to you, Corrina.
Terrific. Thanks very much to Rob and Jarrod for those really insightful comments. That was a really fascinating overview. We might go to some questions now, and I'm seeing a few pop up in the chat. So we'd really like everyone to have the opportunity to ask questions. You've got the Q&A function there, and we'd really welcome anyone who's joined the webinar today to pop a question in the chat so we can pose it to either or both the speakers. So invite you to go ahead and do that now. I'll kick off with an opening question while we wait for people to type. And I might pose this one to Jarrod. Jarrod, inflation is the word of the month. Everyone's wondering what's going to happen next. There have been some changes, as you said, with the unemployment rate starting to go up today and a few indicators that we're seeing a bit of movement. What's your view on the outlook now, Jarrod, for inflation, and how do you think it's going to be managed by consumers and businesses in the year ahead?
Yeah, look, I think unfortunately it's still too high, and I think that's hard for people to hear at a time when we have seen interest rates ratchet up so much and people are doing it tough, but it is proving to be sticky on the way down, which is exactly what we saw in the United States as well and continue to see there. And we're also dealing with services inflation, and I think we've got to realise the past global inflationary episodes were very much around goods. Services weren't as much a part of the economy as they are now. So there's a little bit of uncertainty here in terms of how quickly services inflation comes off. So I think the Reserve Bank's probably still got one or two more increases to go before they can call time. But today's labour market numbers probably will give them a little bit of pause for thought. The other thing that I think is going to help the Reserve Bank to finish its rate rising task is the fact that we've got over this current quarter and the next quarter, we will have 2/3 of those people who are on ultra low fixed rates coming off them and back onto variable rates. So I think that's going to make for a significant adjustment, and it is going to really slow down the economy, and so I think we will start to see an end to that rate rise cycle.
Fantastic. And just one other thing, you mentioned migration earlier, Jarrod, and just wondering if you see any concerns about that also fueling inflation and our housing shortages. Really interested to get your take on that.
Yeah, look, I think the thing is that in the long term, which is what we should all be focused on, migration will be critical in terms of building productive capacity and taking pressure off inflation. And we see that in terms of the working age of our migrants. We have over 80% of migrants tend to be of working age compared to kind of 60+% of the domestic population, which is really important in terms of adding to our workforce. And obviously really important to a number of our sectors, including international education and tourism. I think we need to stop making excuses around planning and zoning and building more housing. It does feel like every time we have this issue around pressures in the housing market, we tend to go straight to blaming population and migration that we should be planning for. We do need to build more houses. We do need to unshackle planning and zoning laws. And so I think the suggestion in the migration review of having a long-term planning horizon for migration and looking at the numbers 10 years out, even though that might change a little bit over time, I think that's the way to go, because I think we can overcome this issue that we keep getting into where every time we end up with infrastructure or housing shortfalls, we talk about suddenly tapping the brakes on migration. I think we've kind of got the approach the wrong way around.
Thanks, Jarrod. Now, we did have some questions submitted in advance. So, Rob, I was going to ask you about where you see trade with China standing at the moment, and that might be a nice segue to the question we've got in the chat. So do you want to start on the question of China more broadly, and then we can go into hydrogen?
Yeah, well, I think we've seen that, trade with China has really rebounded as China has reopened, and also as China's started to remove some of those punitive trade measures. Look, I would say the opportunity with China is still, quite significant. And it's really up to Australian businesses to just look at the market I'd say with fresh eyes and decide, you know, how do they balance that risk and opportunity, and how much focus do they want to put on China? So, you know, the market's evolving very rapidly, but I would say the prospects are there. They're very good. It's just about, in terms of your international strategy, do you focus only on China, or do you focus on China plus one, or China and other markets? So we're seeing good momentum on the political front. The Trade Minister was obviously there recently, and some positive signals and some reports that the Prime Minister, you know, might be going in July. So, you know, particularly for our wine producers, who I think would very much like to see a breakthrough. Hopefully we see continued momentum there.
Fantastic. Thanks, Rob. And then the question we have in the chat is actually in relation to China as well, and a question around how far away is China from using green energy to power hydrogen plants? Do you have a view on that, Rob or Jarrod?
How far away is Australia from commissioning a hydrogen plant? Look, I'm going to respectfully excuse myself from that question. Certainly a lot of advances being made in the region. We are seeing progress in Australia. I think the key thing to note is just that this really is a multi-decade endeavour to build the hydrogen industry, and particularly green hydrogen. That's what we're focused on, and that's what the $2 billion is for. It is restricted to green hydrogen, which is completely powered by renewable energy. So that's going to take a lot of innovation and a lot of investment. But hopefully these new policy measures start to move that industry in the right direction.
Thanks, Rob. Now, Jarrod, we did talk a bit about there's not so much structural reform in this budget, and wanting to get a sense of what you think the appetite might be going forward to think about tax reform. And we do have a question here about that with regards to income tax relief. So do you see that this budget's setting us up now to have a further braver conversation around tax reform?
Oh, the $1 million question. Well, boy, we've had some starts at this in the last decade, haven't we? And we haven't quite got there. I think probably the one to watch on this will be the intergenerational report. I think it's probably the really good place to start with a conversation around what the task for the tax system is likely to be over coming decades, based on our demographics, based on growth factors, and also based on the services that we're going to have to fund. And that's actually a good place to start for us, because too often the conversation gets straight into individual tax bases very quickly, and economists are most guilty of this in this sort of conversation, where we pick out our favourite tax bases that we'd like to get rid of, or inject more of the kind of tax task onto. So I think we've got to start with what's the problem, what are we trying to achieve with tax first, and then I think we can get into more of the specifics, and maybe that builds the momentum that the government can take some more kind of ambitious tax reform to the next election, although we know from past elections how challenging that can be. I think there's a specific question there in the chat box around individual income tax and our heavy reliance on individual income tax. This is a big issue. Bracket creep is absolutely the thing that's holding up the budget and funding things. But we do have an aging population, and I think both electorally and economically, it's really difficult to continue to have an increasing burden of tax on the working population. So we are going to have to look at addressing bracket creep, and that, you know, when people have debated the stage 3 tax cuts, the thing that doesn't go away, even with the stage 3 tax cuts, is that you've got more to do just to address bracket creep. So we do have to have a conversation around how we shift our tax bases, and that is going to, you know, touch on some very sensitive political areas of taxing consumption more, taxing, you know, capital in a different way than we have in the past, because I don't think we can rely so much
I think Jarrod's just paused there, but we understood the point about not relying so much on the income tax base. Thanks, Jarrod. Rob, while we wait for Jarrod to come back, I might pose another question and just again invite others to put further questions into the chat. So Rob, you touched on the National Reconstruction Fund and the government's suggesting that's a way they'll partner with business to unlock further investment. Just wondered if you might reflect on that a bit further and what some of the opportunities might be.
Yeah, look, I think the NRF is a really interesting one, and we know that it's moving into its establishment phase, and a lot of the parameters around the sort of investment that the NRF will be able to support will be decided by its board. So some of those, I think, connections to international investment, both inbound and outbound, still remain to be seen. What I'd say is, we know how globally interconnected supply chains are, particularly in the sectors that the government wants to incentivise around advanced manufacturing, around critical minerals, renewables, and EVs, and so forth. So, yes, the government wants to create jobs here and boost industry here, but you can't ignore the international dimensions to supply chains and value chains. So I think there is a big question coming for the NRF when it's established around where and how does it draw the lines in terms of supporting projects that have international connections and international investments. I think it's a really important one for us to watch.
Fantastic. Now, we don't have any other further questions in the chat, so I might pose one to both of you to wrap us up. Really interested to just get your final thoughts on the outlook for investment and what you might like to share with this audience, given it's largely a business audience, to close out the session today. Do you want to start with that, Jarrod?
Yeah. Look, the budget papers painted, in the short term, some green shoots around business investment, which we always seem to be talking about, and I did kind of have to take out the magnifying glass as I looked at the chart in the budget paper around where business investment was going, and I have been one of those people who've predicted green shoots for a long time and seem to be proven wrong. But I think if you look at what I saw at the start of the year, when we were talking to a number of our members, a lot of people were very confident about their company's growth strategy, but a little bit reticent about the current economic environment and the cost of some investments and the difficulty in getting the skills that you needed to facilitate those investments. And so I think a number of things have been kind of put on ice for a little while just to see how the economic environment plays out. So I actually think once we get through this kind of difficult adjustment phase with inflation, we might actually start to see some of those projects and investments come back. And so I actually think there is some kind of warranted optimism around starting to see investment come off the canvas. And
from my perspective on investment, I guess I'd make three key points. The first is that, we're seeing global growth slow, and the opportunities for growth are in emerging markets, and many of those key emerging markets are in Asia, particularly India and Indonesia. So we know from more of an institutional investor perspective, institutional investors will need to start looking more, at emerging markets. So I think that's one part. The second part is we do see the interrelationship between outbound investment and inbound investment because of how relational investment is, but also because of, in terms of significant investment, the scale of the businesses that you need to deal with, you're really talking about the top end of town. So if you can start to build those relationships and build trust and demonstrate some outbound investment, that'll unlock opportunities for inbound investment. And the third point I'd make on the investment side is that we see a number of other countries really successfully use investment-led relationships with countries in Asia to grow their exports. So this is something, for instance, that the UK and Japan do with India. they have investment-led relationships with India, where they're really responding to India's desire for more inbound investment. But then they use that to catalyze their trade relationship with India as well. So there's a huge amount of connection between outbound investment, inbound investment, and trade, and we need to get all of them working together.
Thanks, Rob. Now, I'm very pleased we've got a few more questions, so let's keep going. Anthony's asked a question which I think will be for you, Rob. You mentioned that the Export Development Grant is going to be phased out. What do you think will be the replacement or any improvements that may occur instead?
Anthony, I have no intelligence at all about what might replace it in the future. The budget papers say that the savings will be redistributed in the portfolio. What I'd love to see replace it is, a really holistic program that looks at all the dimensions that businesses need to consider when exporting. So not just the go-to-market side, but also the enabling functions that are just crucial to business success. And then wrapping around that all the support that businesses need in terms of peer support, coaching, mentoring, and developing their Asia capabilities. So taking that really holistic approach to supporting export, I think is probably the next step in where we go in this sort of area.
Fantastic, thank you. And just a final question, we've got obviously the US Inflation Reduction Act has been introduced. Any reflections on that, on the implications for Australia? Would either of you like to take that question?
I think that sounds like a question for you, Jarrod.
I think the interesting thing about this, and we're going to see more and more of this in years to come, is the incredible level of competition that there are going to be for resources to develop green energy. And so I think what this does is it makes Australia's job a bit more difficult in terms of getting those resources and investment, because they're going to be flowing to places like the US that have these funds and big opportunities. We can't necessarily compete with that. We can't compete with the quantum of those sorts of packages that you're seeing overseas. So we need to find other ways to compete, but we should not be naive about the fact that we're going to see a lot of this, and we're going to see a lot of competition for the same resources. Think about how many countries are going to be looking for copper as they start to rewire their countries. And someone has suggested to me the possibility that you'll start to increasingly see governments looking at buying copper mines, which is very interesting. I will say there's one country in the world that has a copper strategy, and that's China. And so it's being really planned and strategic, I think, about the challenges that we're going to face and getting the resources that we need to make the energy transition.
And I just build on that and say, geoeconomics is back, and it's been back for a little while. And anecdotally, what I heard last year when the Inflation Reduction Act came through, a lot of businesses had to go back to the drawing board in terms of where they were with their strategies and their plans, because all of a sudden, countries that weren't key US allies or partners weren't as attractive from a business case perspective. So thinking through that in terms of the supply chain is really important going forward.
Fantastic. Well, thank you both so much for your insights today. It's been a pleasure. And thanks to all of those who have joined the webinar and to those who asked your questions as well. We really appreciate that engagement. So on behalf of everyone, I'd like to thank our panellists, Jarrod Ball and Rob Law, for those insights. It's been a really interesting discussion, and we appreciate everyone's time today, and thank you for joining us. Before you leave, I'd just like to encourage all the participants to please complete the survey that's available in the chat and will be sent to you after this event. That does help to give us feedback on how to make these events even better for you into the future and to make sure they're targeted appropriately. So thank you all again, and we look forward to seeing you at another Asialink Business event soon. Have a great afternoon.